Hey everyone, welcome back to Corporate Decoder, the place where we really dig beyond those polished corporate press releases, and boy, do we have a story for you today. This latest filing from Equiline Community Development Fund is packed with, well, let's just say some very specific kinds of lending and a whole lot of risk before we dive in. If you like getting straight talk about what is really going on in the world of business filings, make sure you are subscribed. And hey, we've built a fantastic community over on Discord where we break down these documents even further. So join us there too, the link is in the description below. So what exactly are we looking at here? It is a registration statement, specifically a Form N-2 for the Equiline Community Development Fund. Think of it as a company announcing its plans and asking for permission to sell its shares, or in this case, its beneficial interests. They're really focused on investing in loans that help communities, like those backed by the Small Business Administration, or SBA, and US Department of Agriculture, or USDA loan programs, and loans from the Bureau of Indian Affairs. It is all about community development, hence the name. Their main goal is to provide income, while also helping investors get good marks for their community reinvestment efforts. Their strategy is to put at least 80% of their money into these community development loans. Let's look at how these loans are structured. Take this example showing a building acquisition. A significant chunk, 60%, comes from a first lien loan, and then there is a second lien loan, and the borrower puts in 10%. Now here is where it gets interesting. Those first lien loans, the ones the fund primarily invests in, are not guaranteed by the SBI or any government agency. That means if the borrower defaults, the fund is relying on the value of the property itself. And speaking of risks, this filing is absolutely packed with them. It even has a whole section just for risks, and it's not for the faint of heart. They warn you up front. An investment here is subject to investment risk, meaning you could lose all your money, plain and simple. Then there is the issue of marketability. Their shares aren't traded on a stock exchange. So if you want to sell your shares, there is no guarantee you'll find a buyer easily or at a good price. To try and help with this, they do offer to buy back a portion of shares periodically, but even that comes with risks. Your request might not be fully accepted, and it could hurt the fund's performance if they have to sell investments at a bad time to pay people back. They invest heavily in these community development loans, and these loans are not rated by credit agencies. They believe if they were rated, many would be considered junk bonds. That gives you an idea of the risk level, and since these loans are not easily traded, it is hard to sell them quickly or for a good price if needed. Because these loans are so hard to value and trade, the fund relies heavily on its own judgment to figure out what they're worth. This means there is a real risk that their valuations might not be accurate, and they could sell something for less than they think it is worth. And get this, they might even concentrate up to 50% of their investments in hotels and other hospitality businesses. If that industry takes a hit, the fund could really feel the pain. The fund also uses leverage, which means they borrow money to invest. This can boost your returns when things go well, but it can also make your losses much bigger when things go badly. Now, let's peek at some financials. Looking at the year ended the 30th of June 2025, the net asset value per S-share started at $9.24, and for that year, the total income from their investments was $0.56 per S-share. By the end of June 2025, their total net assets were about $31.3 million. That is a drop from around $36.7 million the year before. Even after waiving some fees, the total annual expenses are about 3.59% of their assets. That might sound small, but remember, this is a fund focused on community loans, not high-growth tech stocks. This table here shows how using borrowed money or leverage amplifies everything. For example, if the fund's investments went down 10%, shareholders could see their own returns drop a whopping 15.23%. That is the double-edged sword of leverage. And here is something interesting about who owns the fund. As of October 2025, Colony Bank held about 20% of the shares. That is a big chunk, and it means they could have a significant say in how the fund is run. There are a few other banks too, holding substantial amounts. The fund is overseen by a board of trustees. They have independent trustees, meaning they are not directly tied to the fund's management, which is a good sign for governance. Their investment advisor, Equiline Capital LLC, is paid a fee of 1.50% of the fund's average net assets. That is what they get for managing the money. And you can see here how much they actually paid out in management fees each year, after some expenses were waived. It shows they did waive a good chunk in 2024, but had to pay more in 2025. Determining the value of these community development loans is quite complex. They use a method called discounted cash flow, which in simpler terms means they're trying to guess future income from these loans, and, well, figure out what that is worth today. This involves a lot of assumptions, especially about interest rates and whether borrowers will actually pay back the loans. Because of the way these loans work and the income they generate, there are some specific tax considerations for shareholders, and they really advise you to talk to your own tax expert about all of this. As of September 2025, there were only 17 record holders of common shares. That is a very small number, which could mean less liquidity and more influence for those big shareholders we talked about. And all these records, the money stuff, the loan details, the compliance checks, are spread across various locations, managed by different companies, which is pretty standard for funds like this. Now, looking at this filing, Equiline Community Development Fund is trying to do something good by investing in underserved communities, which is admirable. However, the business of lending, especially to small businesses and in specialized areas without government guarantees, is inherently risky. The heavy focus on loans not guaranteed by the SBA, combined with the illiquidity of these assets and the potential for concentration in industries like hospitality, presents significant downside risks for investors. While they aim for income and capital preservation, the junk bond-like nature of many of their investments and the reliance on their own valuation methods means there is a real possibility of substantial losses. The leverage they use amplifies this risk even further. The fact that they may close the fund to new investors when assets reach $500 million suggests they believe a larger scale might be needed for diversification and to manage risks better, but being a non-diversified fund means they are still heavily exposed to individual loan risks. The large ownership stakes by banks also create potential conflicts of interest that investors need to be very aware of. So in conclusion, this fund is definitely not for everyone. It is for investors who understand and can tolerate very high risks for the potential of social impact and decent income. But with a significant chance of losing money, it is a niche investment. And understanding the deep risks involved is absolutely crucial. Alright, that is our breakdown of this filing from Equiline Community Development Fund. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.